Recently, I got asked on Blossom social app why my wife and I are putting such a large portion of our investment in the stock market in one single ETF. And that's no other than iShares Core Equity ETF portfolio, ticker symbol XEQT. So in this video, I wanted to touch on that, why we are invested so heavily into XEQT. We have over 16,000 shares of XEQT in our portfolio with a total market value of over $400,000 in terms of dollar value, which accounts for almost 90% plus of our entire investments in the stock market. So I'll touch on that, why we are picking X equity, and also be sharing with you what type of investors I personally think would benefit from holding onto a share such as X equity. When it comes to X equity, iShares Core Equity ETF portfolio, it provides you 100% exposure to the stock market. There's no exposure to bond market or fixed income here. It's in a nutshell, it is a simple and efficient way for folks to gain exposure to a portfolio of index funds that provides them a global diversification. Through X equity, and but only holding on to this one single fund, you're getting exposure to the entire US stock market, you're getting exposure to entire Canadian stock market. On top of that, you get exposure to international developed markets, excluding Canada and US, as well as exposure to emerging markets. Now, the percentages of that exposure, of course, differs with US stock market holding and forming actually the largest portion of your exposure. I'm going to quickly show you from the holdings by exposure by different markets. As an example, ITOT, which is iShares Core S&P Total US Stock Market. It's one of the main holdings of X equity. Through it, you are getting around 46 to 47% exposure to the US market. Next, you have exposure to East and Far East in IMI index, which is essentially that international developed markets excluding Canada and US. And for that, you are getting around that 24 to 25% exposure. We also have around 24% kind of exposure to the Canadian markets through XIC, iShares S&P Toronto Stock Exchange Capped Composite. The XIC is one of the underlying holdings for X equity. And lastly, you're getting around that 5% exposure to emerging markets, which is gone and done through actually XEC, iShares MSCI Emerging Market. Now, the fee that you will be paying as part of owning X equity is only the total of a management expense ratio of 0.20. You won't be paying any other fee like specific to any of those other underlying holdings that we talked about. The 0.20 is the entire amount that you're paying. Now, to try to address the question that the person asked me on Blossom, and specifically they were asking, isn't it perhaps better for you to instead perhaps invest in some of those blue chip companies, pick and choose stocks like Amazon, Google, and the likes? So I wanted to take a quick look at it. One of the things I also noticed is that on Blossom, when you look at the list of the top bought kind of funds, as well as the type of funds that are mostly held by blossomers, you do see some familiar names like such as VFE, which is essentially Vanguard S&P 500 ETF. And it has its own other equivalencies, even in the BlackRock. At the end of the day, or even BMO, others. At the end of the day, all of them are still getting you exposure to that 500 largest US companies that are available as part of the S&P Standard & Poor's 500 index. That's one thing to consider. You also see a lot of interest for folks that want to invest in NASDAQ 100 because, they think that because of that higher exposure to the technology sector, you're going to have better returns. And some of the past returns also make them more convinced that why they need to definitely include holdings of NASDAQ 100 as part of their, portfolio. Therefore, what I've done, I've actually gone ahead and take a quick look at the holdings that we get through X equity. Through X equity, you're getting exposure to almost 9,000 plus companies throughout the world: US, Canada, international developed markets, and emerging markets. And then I try to compare them head to head to the list of funds that you get through S&P 500 in the US, as well as the NASDAQ 100, and see what is the gap. Are all of those funds available through S&P 500 and NASDAQ available in X equity? And my conclusion from that would have been, if, let's say, by owning shares of X equity, I'm already getting exposure to shares of NASDAQ 100 and the S&P 500, then I wouldn't see any need why I would want to hold on to NASDAQ 100 or S&P 500 ETFs or companies separately, because I'm already getting exposure to that. My findings actually were quite interesting and very much aligned with what I thought before. When I compare XEQT head-to-head to XUS, XUS is S&P 500 index ETF offered by BlackRock, which is very similar to VFV. The reason I went with XUS and not VFV is that when I downloaded shares of VFV, underlying holdings of VFV, it doesn't usually easily give me the ticker symbol. So it was very hard to do the comparison. But at the end of the day, like I said, both XUS and VFV are very much the same because they are giving you exposure to that 500 or so US businesses that are available as part of the Standard & Poor's 500 index. My findings pretty much showed that I saw 100% match and duplicate on all of them. In other words, the entire companies that are available in the US S&P 500 are available as part of underlying holdings of XEQT. So you don't have to really hold on to US S&P 500 separately. You just can simply own the shares of XEQT alone. I also did a comparison between the shares of NASDAQ 100 versus XEQT. And here, very much similar conclusion. There were only 3 exceptions that I could not find in XEQT, and I'm going to quickly show you what they are. One of the companies was the ticker symbol MELI or Mercado Libre. This is the company that is available in NASDAQ 100 index, but not in XEQT. There's two more that I found. The other one is GFS, Global Foundries Inc., and lastly, JD, the JD.com, the Chinese business incorporated. That's the one that is not available as part of the shares of XEQT. But other than that, pretty much 97% of shares of NASDAQ 100 is available as part of holding of XEQT. I would say virtually all of them are included. I think holding on to shares of XEQT is not going to actually deprive me from getting exposure to those high quality US businesses that many investors think you gotta have as part of your holdings. Pretty much, in fact, if you look at the large holdings in XEQT, the main ones, let's say if you look at the top 10 based on aggregate underlying holding, you're seeing all those names that I was asked before about: Apple, Microsoft, Royal Bank of Canada, Amazon, TD, Nvidia, Google, Tesla, Canadian Pacific, Kansas City Limited, Enbridge. All of them you're getting exposure, and the weightage is also showcased for you here, how much weightage they have in the overall 100% that you get through XEQT. There's also this other content that I found on BlackRock website. It's called Diversifying Investments as part of its Module 5 of Portfolio Construction. And it actually talks a little bit about what are some of the values of diversification. For instance, it talks about the key purpose of diversification is to minimize against market downturns. In doing so, this article acknowledges that there is a chance that, of course, you may be limiting the extent to an upside because you are kind of exploring various diversified market sectors, asset classes, sectors, and geographies. But at the end of the day, that's not the key intent for diversification. And in fact, the key intent for you is to try to kind of limit your downside. As the article put it, it's trying to help limit exposure to significant losses in the market during those downturns. And they talk about mitigating risk, helping improve returns, and overall helping achieve investment goals. Further down, it actually also talks about the value and the benefits of holding on to your investments, stock market investments, over the longer period of time, and how when you are invested for a longer period of time, your chances of success and likelihood of positive returns are increased. They have looked at the rolling returns of stocks between 1928 to 2018. And over that long span of time frame, if you only look at the monthly kind of returns, so let's say if you've invested for 1 month during those rolling returns, what are your odds of coming out of it with making positive money, positive return versus negative returns? For a monthly time frame, the odds of having positive return is still high at 62.4 versus 37.6 for negative return. But this odds actually increase drastically when you're invested for a longer period of time. So for instance, if you're invested for that 10-year over those rolling kind of returns of stocks over those 80 to 90 years, as you saw there, you're still noticing that the odds goes drastically towards a positive return close to 95% positive chance of return, a chance of positive return versus only about 5 to 6% chance of negative returns when you're invested for a 10-year time period. Any of those 10-year time period during those 90 years when you look at the rolling returns. I've also looked at this table in terms of different time horizons, whereby they looked at the growth of an initial $100,000 invested if compared to S&P 500 index versus a portfolio of diversified across different asset classes. For this portfolio diversified across different asset classes, they're mainly looking at around the 60 to 40% breakdown, 60% to stocks, 40% to bonds. And they talk about 40% of that is to S&P 500, 15% to international markets, 5% to Russell Index, 30% to aggregate bonds, US aggregate bonds Barclays, and 10% to Bloomberg Barclays US corporate high yield index bonds. And you do see how over different years, there are years that, of course, S&P 500 may return so much better. So, for example, 2009, 2017, S&P 500 overall returned 258.8%, whereas diversified portfolio only returned 152% or so. But during those, there are years that you see downturns, and in those years, the diversified portfolio actually managed to protect you against those drastic downturns. And they also looked at the growth of $100,000 over the entire time period based on the total return. The total return between 2000 to 2018. In fact, the diversified portfolio returned better than the investment of the same amount in S&P 500 index alone. Something for you to keep in mind. And in this case, it shows why diversification can be valuable. Now, for us, we are mainly invested in XEQT. 90% of our portfolio is in XEQT, which is, as you kind of by now very well know, is 100% stock. So you might be asking more, hey, you talked about diversification. How come I see that you're having geographical diversification? Sure, it's globally diversified. You're also showing us some diversification to different sectors. But how come you're not diversified across different asset classes and you're only in stocks? And now that's a good question. And I think my response to that, and I think the way that I kind of rationalize it for myself, is that I currently am working, and so is my wife, and we do have our salary and income we get. Plus, for me, I have a defined benefit plan, pension plan. And I think I read in some of the past posts on Blossom that many folks that are kind of blessed enough to have a defined benefit consider that almost like a bond portion of their portfolio, especially during the years that they are going to be retiring and kind of getting that pension, because it's guaranteed income depending on how many years you work, what was your high salaries, and a few other calculations. But pretty much that's a kind of a guaranteed income pension that you get, which has a lot of similarities to what a bond kind of offers. That's security and safety. On top of that, we do have our principal residence here in Canada, so we have some equity in our home. The other thing that I would say is that as part of our net worth, we always make sure that we keep aside and save aside at least around that 10% or so of our overall net worth in cash. So I think that's another way we try to kind of preserve our assets and not just put all our eggs into one basket, have a little bit more of a safety cushion on the side. Well, there you have it, folks. A quick look into why we are buying the portfolio the way that we are. I think you've seen it from our past videos, our overall portfolio. I've also shared kind of transparency, the link to our portfolio, which you can always take a look at and see where our portfolio is at, how is it doing, and how we are approaching the investing in the stock market. If you're interested to follow my journey along and learn more about our buys in the stock market as they happen, I do encourage you to follow me on Blossom social app. You can definitely easily download the link provided in the video description, as well as all the links provided in the social media channels that I have through the profile accounts. Thank you so much, everyone, for watching the video until the end, and I hope to see you all next time.